This is Bloomberg Daybreak Weekend, our global look at the top stories in the coming week from our Daybreak anchors all around the world. And straight ahead on the program, another earnings season begins this Friday. Some of Wall Street's biggest banks reporting. Plus, the Archegos jury scheduled to begin deliberations this week, and we'll get you up to speed. I'm Tom Busby in New York.
I'm Caroline Hepker in London, where we're delving into the key issues facing the UK's newly minted government.
I'm Doug Krisner, looking at the level of worry over the economy among policymakers in China.
That's all straight ahead on Bloomberg Daybreak Weekend on Bloomberg 1130 New York, Bloomberg 99.1 Washington, D.C., Bloomberg 106.1 Boston, Bloomberg 960 San Francisco, DAB Digital Radio London, Sirius XM 119, and around the world on BloombergRadio.com and via the Bloomberg Business app.
Good day to you. I'm Tom Busby. Earnings season kicks off this week. Some of Wall Street's biggest banks will be reporting. And for a preview, we welcome in Bloomberg Intelligence senior banking analyst Allison Williams. Well, Allison, let's just say, what are you expecting to see from these big banks that start this Friday? JP Morgan Chase, Citigroup, Wells Fargo.
A couple of things that we'll be focusing on. First, net interest income. This has been an area of pressure in recent quarters, but we have seen signs that those pressures are abating. And what we're going to be specifically focusing on for the banks are what are the deposit trends in terms of seeing some of that, some stabilization on that front. Secondly, are there any changes to the outlook based on what we have seen in terms of expectations for interest rate cuts? And so over the past few months, things have been a little bit more stable than the bigger changes that we saw to start this year. But keep in mind that when we heard from the banks in April, most banks were a little bit hesitant to make changes to their forecasts based on the movement. And so specifically, we'll be listening for Wells Fargo to see if there's any changes to their outlook. JP Morgan has already increased its outlook on the net interest income front. That was some of the news that we got at Investor Day. We also heard from them that their expenses are going to be higher, but some of that is because they are pulling forward some investments because they have a sizable gain to work with. And then for Bank of America, the bank has been expecting that this quarter will be the trough in their net interest income, so we'll look for confirmation on that. Citigroup expecting to see some weakness, but there are some offsets on the fee line.
Now, besides net interest income, of a particular note to you, trading and fees.
Trading and fees. Trading really continues to be resilient. And we have said that we expect that this revenue item keeps within the historically higher range. And that is what we've seen for the past few quarters. We've seen some differences in the drivers, but we do expect that continues this quarter and the quarters ahead. Within fixed income, it's really the credit trading business that we expect to be the outperformer. We've seen good activity in mortgage-backed securities as well as asset-backed securities. We've also seen currency trading showing some positive trends, as well as our expectations that equities trading should also be helped by some of the very strong stock price movement that we've had. We think the prime brokerage business will continue to support the bank. So when we look at trading, we're expecting that revenue relatively resilient compared to the prior year. We do think that we'll see some seasonal decline, which we typically do see in the second quarter. But the fee side is really where investors are focusing on. Trading is a much bigger piece of the revenue pool, but the fee side is a focus because we have had such lower levels, following the boom that we had in 2021. We saw a big decline the following year, and then last year, really the big rebound that many had hoped for failed to materialize. What we've seen in the first half is really strong debt issuance. So that's where I think we're going to continue to see some of the biggest strength in the second quarter. On the equity underwriting side of things, we are seeing some positive activity within the US and European regions. So we think that's helpful, but there's still a lot of room to run in terms of overall issuance and especially IPOs. So we're going to be listening to hear what the banks have to say with regard to pipelines and if some of the very strong equity prices can help to give a little bit lift on that front. Finally, M&A. Again, this is a business that was relatively depressed last year and really looking to get some improvement. We think that really after the election is when we can start to see things pick up a little bit there. It's really about the uncertainty. And we think that following the election, one way or another, there will be at least a little bit more certainty to help CEOs in their decision making.
Well, our thanks to Bloomberg intelligence analyst Allison Williams. And we stay on Wall Street now, but shift gears to the courtroom. Jurors expected to begin deliberating in the federal fraud and market manipulation trial of Archegos capital management founder Bill Wong. And to bring us up to speed, I'm joined by Bloomberg legal reporter Chris Dolmetsch. Chris, some are calling this Wall Street's trial of the decade. Why? What is Bill Wong and one-time CFO Patrick Halligan? What are they being charged with?
Yeah, it is a fascinating case. The trial's been going on for nearly 2 months. It started in mid-May. The two men are charged with kind of separate things. Archegos blew up in March 2021 when its biggest position, Viacom, issued a secondary offering and kind of set off a domino effect that led the firm's counterparties to start issuing margin calls and eventually led to its collapse basically a week later, or within the same week, I should say. Wong and Halligan, the firm's former CFO, are charged with a racketeering conspiracy for allegedly lying to the firm's banks and counterparties about the size of its positions, what investments it held, and how much credit it had at other banks. Which the government alleges led to the kind of collapse of the firm in the end. Wong is also charged separately with working with the firm's former head trader, William Tamita, to artificially increase the price of the stocks in its portfolio in order to keep it, grow its assets and continue making money. So it's a fascinating case. Like I said, it's been going on for nearly 2 months, and the two sides will give closing arguments on Monday, and the jury could get the case as soon as Tuesday.
So the question for the jury, were the actions of Archegos just careless, reckless, or something much worse?
The real question is whether they were material to the bank's decisions whether to extend credit to them, really is the main question there. And what that means is essentially, would a reasonable investor or a reasonable counterparty have taken the alleged misstatements that they made to them into account when making the decision whether or not to extend credit? And the jury will have to decide that question. That's a very important question in most of the counts here. So it's going to be an interesting deliberation. We will obviously have no idea how long it will last, but the judge will give his instructions to the jury on Tuesday morning, and they'll get the case shortly after that.
Well, there's a lot for the jury to get their arms around. A $36 billion family fortune wiped out in 3 days, and banks on the hook for about $10 billion in losses. I mean, what was the bank's due diligence? How was that did he look like a safe bet for them, or did they just get bamboozled?
Yeah. It's a mixed bag because there are about a dozen different counterparties, leading from giant investment banks like Goldman Sachs and Credit Suisse, which eventually collapsed in kind of the wake of this blow up. Some did more due diligence than others, but a lot of them have kind of looked anxious to do business with them. They had become a massive kind of player in the family office world, and a lot of times they were maybe taking them at face value. Like for a long time, this was a pretty profitable firm. For a long time, Bill Wong's, thesis and kind of investment strategy was buy and hold. His defense is that he honestly believed in these companies that he invested in, and he was making investment decisions based on fundamentals, and that he wasn't really trying to manipulate the market. But what's clear from the trial and the testimony is that starting around the time of the pandemic, he increasingly directed his traders to trade in increasing amounts, both before market and near the close, and there was a lot more activity than they had ever done before. So it's really going to be a big question for the jury as to what happened here and as to whether or not they're actually responsible for, leading these banks into these decisions to extend credit.
And this all began, as you said, with swaps on Viacom CBS. Then he got into some Chinese tech companies. Did they look like just mundane investments? Did they look like big risks at the time? I know 2020 hindsight is perfect, but, going back to 2021.
Certainly some of them could be considered risky bets. He had, the banks consistently asked him whether he had hedges in place in, pretty liquid companies like, Google, Facebook, and big stocks like that. And they wanted to be reassured that he had, and he did have some hedges in place, but ultimately those were not really, that did not really help him in the end because of liquidity. They called it, and this was a big question in the trial, that Archegos claimed that this was a liquidity problem, not a solvency problem. The government, of course, says they were insolvent. They no longer were able to function as a going concern. So whether or not it was actually a problem of just being able to get the money to pay the margin calls, and that they weren't able to in the end because of this domino effect, or whether or not it was because of manipulation and misstatements they made to the banks. Of course, the defense says, in a lot of ways, these were not misstatements at all, that he believed a lot of the things they were saying, that they were ostensibly true.
Wow. Well, closing arguments expected this week in Bill Wong's federal trial, Wall Street's trial of the decade. Our thanks to Chris Dolmetsch, legal reporter for Bloomberg News. And coming up on Bloomberg Daybreak Weekend, we head across the pond to look at what the results of this past week's UK parliamentary election could mean for that country's and Europe's economy. I'm Tom Busby, and this is Bloomberg. This is Bloomberg Daybreak Weekend, our global look ahead at the top stories for investors in the coming week. I'm Tom Busby in New York. Up later in our program, more trade and inflation data from the world's second largest economy. But first, what will last week's election results in the UK mean for that country's economy? For more, we head to London and Caroline Hepker, the host of Bloomberg Daybreak Europe.
Tom, after a brief and difficult election campaign, including many hard-fought battles over the economy, immigration and public services, to name a few, the British electorate has finally made its choice. Whilst the snap summer poll may have come as a surprise to many, even those well-versed in the ways of Westminster, the dismal inheritance awaiting the next government will be news to no one. Britain's problems have been piling up since the 2016 Brexit referendum, which triggered years of Tory political infighting. Add to that a global pandemic alongside current geopolitical unrest, and some would argue you're left with the perfect recipe for political disaster. Former Conservative Government Minister Sam Gyimah has been speaking to Bloomberg, telling us that the next government's navigation of relations with the European bloc will now be critical.
Foreign investment is a big thing. Is this going to be a government that is domestically focused, or is it going to really get out there, almost go on a roadshow and to try and attract foreign investment? I think here the public is leading opinion rather than the politicians. And I think most of the public today, if you poll them, will say that Brexit has been a mistake, to put it bluntly. But I think the direction of travel from here is an easing of relations. Where we've been is that anything that is from the EU has to be treated with deep skepticism and therefore not getting involved with. So that's one aspect of it. You quite rightly pointed out. I resigned from government in 2018. I read the tea leaves that the Conservative Party was embarked on a journey that would not be constructive for the country. In fact, it's been destructive for our economy. And my personal hope is that we get back on an even keel. That's not to relitigate the referendum, but to actually remove some of the sanctions we've effectively imposed on ourselves as a country.
That was Sam Dumar speaking to Bloomberg Radio. Right now, the UK is also facing a fiscal straitjacket. This is the product of years of crisis spending spurred by the COVID pandemic and a need to help families to cope with the cost of a living shock after Russia's invasion of Ukraine. Today's government is presented with crumbling public services that desperately need money, taxes at a post-war high, and national debt at levels last seen in the early 1960s, which cost £60 billion per year just in order to service. As far as the list of priorities goes, it's hard to imagine a world in which minimising the country's economic bleeding isn't high on the agenda. On the campaign trail, growth was a real buzzword as parties promised that the economy could expand its way out of the spending bind. Business leaders will also be key in achieving that, but they will likely have their own set of demands for the new residents of Number 10. Key bosses tell Bloomberg that they're looking for upgraded infrastructure, a focus on the skills gap and a commitment to the climate. Coupled with a strong preference for lower business rates, their requests won't come cheap. Can Britain's next cabinet keep up? Also pertinent will be the housing crisis. Bloomberg analysis shows that the next government will need to build the equivalent of another city the size of London to make up for 5 decades of below-target construction. The shortfall is driving Britain's worst housing crisis since World War II. Alleviating its effects will no doubt be of immediate concern. But is it possible to make up the difference? For almost 5 decades, developers and local authorities have failed to bring new homes onto the market at the pace of other wealthy nations in Europe, or even at the rate that Britain managed during the 1960s. So plenty for this next administration to be getting on with. Where do they start? The new government's proverbial inbox is something that my colleague Tom Mackenzie and I have been discussing with Bloomberg's senior economics reporter Philip Aldrich, our city editor Catherine Griffiths, and our housing reporter Jack Sidders.
It's the combination of the 100% of GDP debt level with high interest rates that has caused real constraints on public spending and what the government can do. The increase in the debt servicing costs has gone up by £60 billion a year since before the pandemic. That £60 billion is equivalent to the size of the defence budget, and you're not getting anything for that. So you have to take money out of services to pay for this debt servicing, or you've got to raise taxes to do this, or you could borrow more and send the debt spiralling further. These are the kind of horrific decisions that are having to be made, and that's why we've seen the tax burden just drift up to sort of the highest level since World War II, because there are these ongoing public spending costs which have got no effect on the quality of public services. Just paying our creditors doesn't help pay for nurses. So that's been this kind of core problem.
Catherine, let's bring you in at this point. In terms of how the City of London is adjusting to the new government, we saw, of course, a number of politicians fighting for the affections of the city and businesses over the last 6 weeks or so. What is going to be at the top of their wish list?
Well, I suppose on the one hand, if they had a kind of ideal wish list, it would be a very, very sort of tax-free scenario or low taxes. So when it's banks, they don't want to have the surcharge on their profits. They don't want to have the levy on their balance sheets. But I think they are realistic. So what they're really looking for, given the constraints that Phil's just outlined, is they want sort of clarity, they want consistency, they want a closer relationship with Europe, and they want the UK overall to be a kind of place where they can attract the best talent. So they want all those other things to work well, public services too, so they can get people to come and work here.
Attracting the best talent, though, means somewhere to live. In the planning system, the housing landscape has been incredibly difficult. Jack Sidders, this is your beat, isn't it? How difficult is it going to be to solve the housing problem?
The fact that you even got me on for this discussion, I guess, is telling of just how much housing has risen up the agenda. The reality is today that a huge proportion of the housing output in this country is delivered by a very small number of private developers. They're not charities. They're focused on margin. And, you've had a period of suddenly increasing interest rates. So a lot of these house builders were very nervous about what demand would look like. So they've slowed down the amount they've been building. Inevitably, that's going to slow down, the overall supply. And you just don't have the money there for the public sector to be building in significant volume as it did, if you go back to the 50s and 60s, which is the last time Britain was really building, what we might call enough homes. The incoming government is got a huge challenge to try and stimulate that supply, and it won't happen quickly.
On the question, Phil, we'll bring you back in at this point. Fiscal rules, big feature, of course, of the campaign, and how a new government will stick to them. As they look to fund services like education and NHS, do they still need to stick to those fiscal rules? Is there wriggle room? Because of course, loosening the fiscal purse to spend on things like tax cuts is very different to loosening the fiscal purse to spend on things like capex.
In March, the OBR forecast that Jeremy Hunt had about 8.9 billion to spend, of headroom under the fiscal rules. So there is going to be real constraints on what they can do, caused by this need to show fiscal sort of prudence.
Yeah, Catherine, in terms of then how that flows into what happens for the UK, how does Britain target foreign investment? I mean, a few days before the election, I remember speaking to the country head of BNP Paribas, Emmanuelle Beurry, and she was saying you need stability that is for more than just 6 months. How is Britain going to bring foreign investment in?
So I think the government will start from quite a good place, which is that the UK seems quite a stable place compared to many other parts of the world, not least our continental neighbours. So it's a good starting point. But I think there are a few things that foreign investors want. For a start, they do want stability. They didn't like the idea of the HS2 extension project going so far down that path and then dropped by Rishi Sunak. So they don't want to feel that kind of domestic politics trumps sort of long-term planning, and they want to have kind of clear sight of what the government will do, whether it's green investment, whether it's housing or other infrastructure, because they definitely want to invest in the UK.
Okay, on that challenge then domestically, Jack, and part of the challenge around building those new homes and reaching those targets has been what NIMBYism has been blamed. So local populations pushing back on developments. When I speak to people about this, those who welcome the development of buildings also say, well, they need to also incorporate things like additional hospitals and schools that come under pressure. How is the incoming government thinking about addressing that part of it? Are they going to rip up the regulations to just get that house building going, even come what may, even if some of those issues are sidelined? Or are they looking to address that as part of the mix?
Yeah, so I think it's really interesting, and in the time that I've spent covering this area, I've never before heard a political party, even though slightly whispering it in the manifesto, even acknowledge the idea of building on the green belt. Now, Labour are talking about building on the grey belt, the bits of the green belt that aren't actually very attractive, but quietly, that's actually really radical. That's been a total taboo in British politics ever since the Second World War. So that is, I guess, probably the first indication of a potential significant change on the supply side. So the previous governments have done a lot on the demand side, policies like Help to Buy, trying to stimulate demand, tinkering with mortgages, all that sort of stuff. But yeah, as you suggested, clearly it's the supply side where the issue really is now, that planning constraint. And you see it, you see it all the time. There's a story in the BBC about a development that was had a lot of objections. It quoted 6 people who are opposed to development, not a single one who's in favour. Just culturally, there needs to be a real change in this country.
But I mean, roads get clogged, schools get overfilled, there aren't enough hospitals.
Absolutely, yeah, and so this is where you need to have. The problem is you have planning delegated to a local level, decided by councillors who are very conscious that their local electorate might not like new homes built in the in the field near where they live. But then you have budgetary decisions and decisions around a lot of those bigger infrastructure things taken to central government level. So there's a lack of things being joined up. Yeah,
Catherine, a last word then on the balance. I think important for our audience between regulation and sort of encouraging growth and prosperity.
Yes, so I suppose actually, of course, the UK's sort of strong regulatory system is one of its key strengths. So I think the government will know that, and investors, whether they're domestic or foreign, also know that. But there's been this real tussle actually since Brexit of the UK needing to set its own policy, and that requires kind of serious thinking, which we just haven't had in the last few years. So I think a sense that people really think that through, how you do balance those two things, will be really important.
My thanks to Bloomberg's senior economics reporter Philip Aldrich, our city editor Catherine Griffiths, and our housing reporter Jack Sidders. I'm Caroline Hepker here in London. You can catch us every weekday morning for Bloomberg Daybreak Europe, beginning at 6 a.m. in London. That's 1 a.m. on Wall Street. Tom.
Thank you, Caroline. And coming up on Bloomberg Daybreak Weekend, a preview of some highly anticipated trade and inflation data coming out of China. I'm Tom Busby, and this is Bloomberg. This is Bloomberg Daybreak Weekend, our global look ahead at the top stories for investors in the coming week. I'm Tom Busby in New York. Over in Asia, we'll be getting the latest slew of Chinese trade and economic data, and for details on what investors are expecting, let's head to Bloomberg Daybreak Asia co-hosts Brian Curtis and Doug Krisner.
Tom, earlier in the week, the official Chinese PMI data showed factory activity contracted for a second straight month in June, and at the same time, a sub-index of new factory orders slipped as demand weakened. Now, this weakness in manufacturing is certain not to please policymakers. They've been looking for improvement.
In May, strong exports kept production lines at the factories humming, but domestic demand remained stubbornly subdued. And rising trade tensions with the United States and also with the European Union have added uncertainty to the prospects for overseas shipments.
And we got some perspective on the Chinese economy from Shahzad Kazi. He is the COO and Managing Director at China Beige Book.
I think if you want to talk about the GDP, I agree that we may not get to 5% this year, despite what the what the party claimed up front. But I think pulling back, let's talk about where the economy is. It kicked off on a pretty solid state in the first quarter, and where you're getting to now is that the pace of improvement has faded. There's no question about it. But we are nowhere near, I think, a level where Beijing starts to feel the pressure to unleash stimulus in large enough quantities, which is what the markets are hoping for right now.
If you're a policymaker, you had been hoping that exports and manufacturing would help bring the economy along, knowing that the consumer side was a little bit weak. And so that's not really happening. So I think what is being suggested by some is that they need to do something. Maybe it comes out of the third plenum, or maybe the PBOC just sort of increases the oomph of the home buying scheme, which could do the trick, but it's just not big enough at the moment.
And look, when they get into the plenum, one of the things I think they may also talk about is claim some victory. Finally, housing, turning in somewhat better news by comparison. By the way, I should point out, commercial property is starting to suffer a little bit. And so increasingly, when we think about the Chinese property market and what needs to be done in terms of a rescue plan, investors might go from worrying solely about housing to worrying still about housing a little bit, but increasingly getting caught up with what's happening to commercial real estate in China.
So we know the story on deflation. To what extent will the PBOC, to Brian's point, kind of lean in and do something that is maybe a little controversial, something very similar to quantitative easing?
We're increasingly hearing about the fact that, the PBOC wants to get involved in bond buying and that sort of thing. So there's a likelihood that we get some more information and announcements to that end, and that can help. But let me point something out. Liquidity in the system has not been a challenge in China, and that is not a challenge today. If anything, I would argue, looking at the data, there's plenty of liquidity out there, and banks are willing to lend. And banks are cutting back on rates. Banks are cutting back on rejections the way they used to reject loans a couple of years ago. Companies are just not going out there and borrowing. So what exactly is the problem and what exactly is the solution? We have to always think about that thing a little carefully.
He is Shahzad Kazi of China Beige Book. And for a closer look at what's happening in the mainland economy, we are joined by Bloomberg's Jill Deeses. She is Bloomberg News desk editor. She was also China EcoGov editor, and we're pleased to have her joining us from our studios in Hong Kong. We can talk about the monthly activity data in a moment, Jill. We're expecting those numbers in the week ahead. Industrial production, retail sales, to name two. Let's jump off what Shahzad was talking about there, particularly as it relates to the plenum. That's obviously the big meeting, top ranks of the Chinese Communist Party. So will concern about the economy, do you think, be the primary topic of the third plenum?
I think at this point, it's a bit tough to say. I mean, look, the economy has done at least reasonably well this year. I realize that some of those numbers recently haven't been particularly strong. I think those PMI numbers from June 30th in particular, a bit weaker than expected, seeing that second month straight of contraction for factories. But overall, I mean, there have been other parts of the economy that have held up decently well. Exports did actually outperform in May. So, leading to there's a lot of concerns over obviously how much EU tariffs and the like are actually going to impact exports in the future. But I think that, the economy did at least hold up reasonably well from a manufacturing export perspective in the first 6 months of the year. Obviously, demand continues to struggle, but that is, at least a question there. I think what you're likely to see, at least with the, this third plenum, maybe there's some talk about the economy, but also I think some of those longer term geopolitical goals that Xi Jinping ultimately has around developing advanced tech do seem to be big factors that he's been focusing on, at least for the past couple of months.
What do you make of that notion that we've heard a little bit more about lately, the possibility of the PBOC scaling up that home buying scheme?
That I think is, maybe a possibility. So this idea is, this home buying scheme introduced in May does seem to be maybe, there's a lot of talk about whether that's really that silver bullet to kind of help, the property market after so many years of, issues and problems. Right now, a lot of economists are still saying, though, that it does lack the sufficient scale needed to actually boost the economy, sort of solve the property market's issues. I think that we haven't really seen a whole lot of continuous months of obviously, that in action to maybe affect something, but that does at least seem to point to, some likely, the strategy that actually might be useful in helping the property market. So maybe there is some room to scale things up there.
Brian and I were talking a while ago about the very strong reading from Caixin, the manufacturing PMI data. That measures kind of small and medium-sized businesses. So let's weigh that against what the official PMI data was indicating. And I'm wondering, is there a bit of bifurcation within the Chinese economy right now, which is to say smaller, medium-sized businesses may be holding up very well, but the larger firms are having some more challenges?
Possibly. I will point out, Doug, that there has actually been quite a bit of divergence between those gauges over the past year or so. The idea that the Caixin gauge actually does outperform the official one quite frequently. I think that really comes down to, first of all, as you mentioned, it is smaller, medium-sized businesses. It's also a lot more export-oriented firms, as we mentioned earlier in this conversation. Exports actually did fairly well in May, so maybe that is an indicator that there has been, some continuing to hold firm at least a bit in June. But ultimately, yeah, I mean, it's difficult to kind of take these things in combination with each other. But, there is that acknowledgement that there's some difference between these things. It does seem to cover different firms, maybe more export-oriented ones. I wouldn't really read too much into the fact that they're diverging just because that's been a pattern that we've been following for quite some time now.
Well, let me give you something else that's mildly positive. We did see a pickup in auto sales in the month of June. And the numbers from BYD at more than 340,000 cars. That was more than 110,000 cars more than the same month last year. And yes, we know that it was because of discounting, but discounting is part of what you do in economic conditions to try to get the sales moving again. So I wonder if some other industries might pick up on that and whether or not that bodes well for the future.
Yeah, I think we'll have to see. I mean, certainly China, at least when it comes to cars in particular, has been a bit smart about trying to gin up demand there. So we'll see whether that continues to hold. I know that, they've also introduced a variety of other schemes over the past several months to try to really, really boost domestic spending in particular. I think that's been to, somewhat mixed effect. Obviously, inflation continues to be quite low in China. We're still seeing ongoing issues with demand there, but there have been various programs introduced to kind of get people to buy more home goods, for example. So I wouldn't be surprised if you see China, try to, gin up some domestic demand by turning to those types of programs.
That's kind of a nice segue into the monthly activity data. We've talked a little bit about the export economy, and that takes care of some of the industrial production component. Retail sales, that's going to be key too, and the health of the China consumer. I'm wondering whether or not there is a way for authorities to dissuade a little bit of personal savings. We know that there's been a great deal of savings going on, and maybe at the expense of the retail economy. Is there any way that authorities could address that issue as a way of ginning up retail sales a bit?
I mean, this is one thing that they've really been struggling with for really the past year, right? Introducing, some, kinds of, this idea of introducing programs that are actually going to get people to spend more money. As we know, China is, incredibly reluctant to roll out policies that you'd see in other economies, particularly in Western economies, such as offering people subsidies to try to get them to spend more. So I'm not sure that we're going to see anything on like an extremely massive scale there. But yeah, maybe there's other types of programs, or at least on like sort of the local government level, maybe you'll see local authorities try to introduce some kinds of programs to get people spending again. It's just it's been obviously an incredibly difficult thing for the for China to really kind of get that going.
More and more programs. One that would affect people like you and me and Doug. Non-Chinese residents of Hong Kong can now get 5-year visas going into China, multiple entry, which is kind of interesting. It's a small step, but it shows that they're willing to try different things.
I'd actually say, Brian, I mean, that's part of this ongoing program that China's really been doing to get, not just, residents of Hong Kong, but also international visitors, going to China more frequently. I mean, look at the number of visa waiver programs that China has implemented over the past several months, right? I mean, you just recently saw Australia and New Zealand added to this program for allowing visa-free entry. There's been some major economies in Europe as part of that program as well. I mean, China, I think, has really been trying to get on the charm offensive with a lot of these, these international tourists and stuff to try to, maybe boost, international spending that way, getting people into China and actually spending money, improving international tourism that way.
So obviously we are heading into a presidential election here in the States in November. There's been a lot talked about where tariffs are concerned on Chinese goods. Do you think this is a worry for Beijing?
Yeah, certainly they're worried about this. I mean, look, you just saw, fairly recently, China's really been trying to push back against a lot of these tariffs. Even the foreign minister earlier this year flagged the idea of tariffs from the U.S. or the EU, as being incredibly unreasonable, as being, sort of a threat, at least, some sort of implicit acknowledgement there. Very recently, you had a pretty high-level delegation from Germany, which has been trying to push for negotiation on these tariffs because of how important Chinese goods are to the German economy there. They were visiting, trying to, figure things out here. As of right now, I mean, you've got some provisional tariffs, kicking in, definitive duties, really more of a likelihood in November of this year. But China, I think, has really been trying to figure out ways to sort of negotiate some of these things down and really preserve that kind of trade. Obviously, this is going to be a big question for China.
Jill, thanks so much for sharing your perspective. Jill Deese is there, Bloomberg News desk editor, joining us from Hong Kong. I'm Doug Krisner, along with Brian Curtis. He's in Hong Kong, and you can join us weekdays here for Bloomberg Daybreak Asia, beginning at 8 a.m. in Hong Kong, 8 p.m. on Wall Street. Tom?
Thank you, Doug, and thank you, Brian. And that does it for this edition of Bloomberg Daybreak Weekend. Join us again Monday morning at 5 a.m. Wall Street time for the latest on markets overseas and the news you need to start your day. I'm Tom Busby. Stay with us. Top stories and global business headlines are coming up right now.